My name is Rhys Davies. I'm the lead fund manager on Invesco Bond Income Plus, which is an investment trust with the ticker Bips on the London Stock Exchange. So I'll refer to the fund as Bips for this presentation. It'll be a lot easier. We titled this presentation "Delivering a Steady Income in an Uncertain World." Actually, that is a title that we put together for a presentation last year, but I think far more meaningful in the current market environment that we have. Some disclaimers there, a little about myself. I'm based in the Henley-on-Thames office of Invesco. My background is as a credit analyst, which is the bond equivalent of an equity analyst. But unlike an equity analyst who's always looking for a company's story, as credit analysts, we worry about the credit risks of lending to that company. And I also manage our Invesco Monthly Income Plus fund, which is a £2.2 billion open-ended fund with a similar focus to Bips, but managed in a different way. So for the next 20 minutes, I'm going to talk about high yield bonds, which is the main investment focus of Bips. And whilst they haven't offered particularly high yields for a while, they certainly are offering a lot more yield now, as Russ mentioned. And so I'll talk about why they're a good place if you are looking for steady income. Then onto the market, and as you know, this year has been a terrible start to the year for financial markets, so whether it's equities or bonds of any types, including high yield bonds, and then onto the fund itself and why we think it is a very nice product for investors that are looking for that steady income stream over the long term, or for those who want to rely on returns from income during more volatile times like this. So first of all, why are bonds so useful when you want that steady, reliable income? Well, the main point really is that when compared to equities, a bond pays that pre-agreed rate of interest every year. So we call that the coupon. It's a contractual obligation, unlike a dividend on an equity. And the second key point is the ranking. So a bond is simply a loan to a company or government, and because of that, it ranks above an equity if things go wrong in a business. But the trade-off is that the upside on a bond is limited, whereas equities, of course, can offer, in theory, unlimited upside, all of which I think gives equities and bonds that different appeal for a different part of your portfolio. So with that in mind, when I say that Bips invests in high yield bonds, what do I mean? Well, as bond investors, we like to categorize bonds according to their level of credit risk. So meaning the credit risk in lending to that borrower. In other words, what are the chances of me not getting my money back from company X? So the rating agencies like S&P and Moody's created the ratings that you can see here that simply rank that risk from extremely low at AAA to, be careful, CCC rated. And those then get split into these two very broad groups. Anything rated BB and below is referred to as high yield. Anything above that is rated as investment grade. And so the yield on bonds increases the further down the risk spectrum they are, meaning a single B rated bond typically yields more than a double B rated, etc. So what it does mean that it's actually the rating which defines whether a bond is called high yield. And for some time, with central banks doing what they've been doing for so many years, high yield bonds have not often been very high yielding. But as I say, that has really changed this year. So in Europe, the high yield index currently yields about 5.8% on a yield to maturity basis. At the start of the year, it was only 3.4%. A very important point to make on this slide, though, is that when we're making those investment decisions in Invesco and deciding whether to buy a bond, we will take note of what the rating agencies have to say, but it's very important that we understand those credit risks and that we form our own view. And so we have a team of analysts who do that, and that's also my background. And then finally, I would say, what are high yield bonds not? It's an odd way to phrase it, but I think it's quite important in today's environment. They're not the same as government bonds and investment grade bonds. Both of those are far more sensitive to movements in interest rates. That has been a big issue for bonds this year. And although, as I say, this year has been a bad year for bonds of all types, it is government bonds and investment grade bonds that have seen the greatest declines in price. And when investors become nervous about rising interest rates, as everyone is right now, they're generally right to be nervous about bonds, because when yields go up, bond prices go down. But I would say high yield bonds are less exposed to interest rate risks. They're not immune to them by any means, but they are typically less sensitive. And that's because the coupons are higher and the maturities tend to be that little bit shorter. What we as fund managers focusing on the high bond market do need to focus on with high bonds are the credit risks, and that is really at the very core of how Bips is managed. So on this page, to give you some idea of the types of names that are high yield bond issuers, we've got Ford, M&S, Rolls-Royce. All three of those examples were impacted by COVID in various ways, and as a result, they were all downgraded from investment grade to high yield. So we refer to that as being a fallen angel. And actually, they only went from investment grade to that double B rating in high yield, which is the first level of rating we refer to as high yield. So for us as a team, with a lot of experience investing in high yield bonds, suddenly having big companies like these trading as high yield and suddenly offering much greater levels of yield was very exciting. Now, I don't want to downplay the challenges that those companies faced during COVID, but they gave us some very attractive opportunities. Rolls-Royce, for example, issued bonds with a 7-year maturity, meaning they must be repaid in 7 years, paying a coupon of 5.75%. And at the time, given shareholders had supported the business with a rights issue, that was a very attractive bond to be putting into this portfolio. In fact, on this slide, all 5 companies on the top row are what we refer to as fallen angels. They were investment grade, they're now high yield, and they can often be really great investments for a portfolio like Bips once they've fallen down into that high yield category. You'll see, as there is also on this page, this is a more typical example of when a company issues a bond that is high yield rated at the start of its life. So Asda spent the past 20 years or so as part of the Walmart group, but last year was acquired by a private equity firm called TDR, alongside the Issa brothers, who set up the EG petrol station chain you're probably familiar with. So to make that acquisition, they used debt, including high yield bonds. The secured tranche of those bonds was rated double B, the unsecured tranche single B. That's to reflect the credit risks of lending to Asda at the time. The coupon on the secured bonds was around 3.25%, and on the unsecured it was 4%. So not particularly exciting at the time, but because of the changes in the market since then, and also the changes to the risks that Asda now faces with input price inflation, energy costs, a weaker pound, among other factors, those bonds are yielding over twice their original yield. So, Russ mentioned me being more excited about the yield that's out there. I am. So for Bips, we weren't hugely excited by Asda's bonds a year ago at a yield of 3.25%. We didn't buy those bonds at the time, but at over 7% today, they're offering a lot more yield and they look far more attractive for an income-seeking fund like Bips. Obviously, we have to understand the credit risks at Asda, and we have to make sure we're comfortable with those. Another example on this page, a company like Virgin Media. They've been a high yield bond issuer for years. It's a fairly unique business in the UK with its cable network. It's a nice business for bondholders because of what it is. Again, rated quite highly for high yield at double B. And today, just with more yield available everywhere, more generally in the market, their bond that has a maturity of 2030 yields almost 7%. So the portfolio is built up with from the bottom with bonds from lots of different high yield issuers like those. And crucially, we're looking for companies that we can rely on to keep paying those coupons so that Bips can then pay that income out to its shareholders on a quarterly basis. Of course, it's never as straightforward as that all the time. There are risks investing in the high yield bond market, and sometimes companies do fail on that contractual obligation. I've included here Pizza Express as an example of that. So some of you may be surprised to know that they went through a debt restructuring in 2020. Essentially, they could no longer afford their debt. And whilst COVID and lockdowns certainly pushed the company over the edge, they'd been looking vulnerable before the pandemic because they had, in our view, too much debt. Pizza Express had 2 bonds at the time. One of those ranked senior. The £200 million junior bond was essentially wiped out. So their investors, their claim became worthless. Whereas senior bondholders walked away as the new shareholders of Pizza Express. So if you own those junior bonds, it was a very bad outcome. Since then, as it happens, a new Pizza Express with a new balance sheet, less debt, has returned to the high yield market. So we're very happy to lend to them at a coupon of 6.75% for 5 years. So as high yield fund managers, there are a couple of ways that we can handle those types of credit risks of the companies that we invest in. The first is we have a team of very experienced credit analysts. They'll spend each day reassessing the credit risks of the companies whose bonds we own. So, for example, our view on old Pizza Express was that the company had some heightened credit risks before the pandemic. And so we'd already sold those bonds. The second way that we manage those risks is a very simple principle. It's through diversification. And by that, I mean Bips will typically have bonds from well over 100 different companies. So that if we do have an example like Pizza Express in the portfolio, the damage to Bips, to the portfolio, is somewhat mitigated. It is a different way of constructing a portfolio than you would with equities. Simply because equities and bonds have those different return profiles, going back to the earlier slide. So moving on to the market, I've already mentioned where yields are today in the high yield bond market. This chart is for Europe, and the US high yield bond market offers a little bit more in terms of yield today. And you can see that putting that brief period in 2020 to one side, it has been several years since we've last had yields like this in our markets. And if you see me present over the past few years, I've mainly been complaining about that fact. So it is a good time to find some yield. The reason for this rapid move higher in yields this year, as Russ has pointed to, it centers around inflation and concerns over central banks raising interest rates to try and tame inflation. On top of that, of course, withdrawing some of the huge amounts of stimulus they provided more recently, which have really played into the yields that you can see on this chart, having been relatively suppressed for some time. The invasion of Ukraine has only worsened some of those issues. So what we do have this year is yields rising on government bonds, leading to yields rising on high yield bonds. And now we also have to be thinking about the potential risks ahead. And that includes, unfortunately, the possibility of recession. So for Bips, that means keeping the portfolio still relatively cautiously positioned in this market, also investing less in bonds that have a longer time to maturity. And then, as we always do, really focusing on the credit analysis of the companies that we invest in. But it is also a much better time for income investors right now, as you can see on this chart. On the next page, these two price charts are just making the point that this has been a very challenging year for our market. So even a company such as Virgin Media, which we like very much in the portfolio, and we feel we understand their credit risks, ultimately we're confident that the bonds we hold will be repaid in full at their maturity date. But the price on their longer dated bond has still fallen almost 18% this year to around 82. There's been some compensation for the income earned along the way, but it's happened really as markets have repriced to those higher yields. And the longer a bond has to maturity, more duration it has, the more exposed it is to those price declines in a rising yield environment. The second example here is a price chart for Daimler Truck. So this bond was actually issued only a few months ago in December. It was issued at a price of par. Bonds are typically issued at a price of par, that means 100. Today it trades coincidentally also at a price of around 82. Daimler Truck is a BBB+, so investment grade rated bond. It's a very good business. It's got strong margins. But nevertheless, about 2/3 of that price decline has been simply because government bond yields have risen this year. The rest of that, the price decline, you could say, reflects a change in how the market is pricing its credit risk. So I think the bottom line for us is there is more yield today, and for some bonds, especially those with longer maturities, with more duration, it has been a painful process to get here, but there is now more yield available, which is great if you're investing for income, and the Bips portfolio is really set up to make the most of that for its shareholders and to pay that yield out, that high yield out, as quarterly dividends. Defaults, I've touched upon the subject of defaults. It is a very important factor when investing in high bond markets. It's where active managers can add some value against trackers on the market. It's the reason we place so much emphasis on our credit analysis, and also why we maintain that good diversification of companies that Bips has invested in. This chart includes forecasts looking forward for default rates in the high bond market. So from Moody's, one of the rating agencies, as you know, financial forecasting, it's impossible to get right. It's not something that I ever want to have a go at. And actually, the forecast that Moody's put together back in April of 2020 proved to be wildly wrong because of the actions of governments at the time and central banks to help companies. But as a general sense of the outlook from here, I don't disagree with this chart. I think high companies have been very good at making the most of the cheap funding that's been available. And so maturities have been pushed out into the future. And so the potential pressures of having to refinance in a more challenging environment have also been pushed out. So for now, at least, I think there isn't anything of major concern around the default outlook, but of course that can change very rapidly. So that brings me to an outlook for markets, and summing up some of the points I've made. There are risks today, and I would say there are more risks today than there were a year ago, whether that's ongoing inflation pressures and the subsequent interest rises that potentially go beyond what markets are currently pricing in, or the potential for central banks to go too far, or rising costs to put too much pressure on consumers and economic growth. So we're still in the phase, I would say, where a degree of caution is warranted, and that is how the Bips portfolio is being managed right now. But the good news is, for income investors, there are more income opportunities. This is a good opportunity for us as fund managers to really add some income back into portfolios, which we've been doing. And then the next phase, which could be very good news ultimately in the long run, is that when high yield bond issuers come to the market with a new bond, if they have to pay a higher coupon than we've seen bonds being issued at for some time, that's going to be good news for the funds, going to be good news for Bips and Bips shareholders. So the final section, looking at the trust itself, and why myself and Ed Craven, the trust deputy manager, think it is a very nice product for investors looking for that steady income stream over the long term. First of all, Bips was actually formed almost a year ago now through the combination of City Merchants High Yield and Invesco Enhanced Income. So they were two investment trusts that we'd managed in the team for many years, which I'd co-managed, initially co-managed since 2014. The result of the combination is Bips is now the largest investment trust in the AIC loan and bond sector. I mentioned diversification is very important. So right now the trust owns 195 issuers, as in different companies, so spreading that risk around. The trust can borrow. It is a common feature on investment trusts and a very important distinguishing feature against our open-ended mutual funds. The ability to use borrowing in a careful, controlled manner, I think it can be a very powerful tool. There are limits in place, so it's currently set at 30% of gross asset value. Today, Bips is around 16% geared on a net asset value basis, and essentially the borrowing is used to buy more of the bonds that we like, to allow Bips to maintain that attractive level of dividend for shareholders without having to buy too many of the riskiest bonds out there to earn that level of yield. It is something we have a very long track record of doing in the team with the predecessor trusts. During my time as co-manager over the past 7 years on those trusts, 7 or 8 years, but also in the time that we managed them within the team before that. And 2020 was, I would say, as good a test as you can get in terms of managing a fund with gearing, with borrowing during a rapidly falling market, as we saw in March, April 2020. Finally, on the dividend, there is a stated target of 11 pence per annum for the first 3 years after the merger, the combination. Today, that equates to a dividend yield of around 6.6%. The idea behind the stated target was to give shareholders that certainty of income during this period. And then, as you would expect, with more yield available today than a year ago when that target was set, that figure is actually much better covered than we thought it would be in terms of the income that the portfolio is generating today. I would also point out from here, Bips currently trades on a small discount to its net asset value, which means shareholders, investors are able to buy shares for around 4% less than the market value. So to sum up, by carefully choosing the bonds for investing and using some borrowing, Bips is able to offer, I think, a relatively high level of income to shareholders who are looking for that steady income. And finally, here's the team. You can see a lot of industry experience, the numbers in brackets, and some happy looking faces. So thank you very much for tuning in, and I look forward to taking your questions later.